This is Just Listen, hosted by George Goodman. Welcome to the podcast. Today, I want to talk about the U.S. federal government policy on the prime interest rate in home loans. There is a correlation there. Currently, in the United States of America, home loans are based on several factors, but I'm not going to bore you with all of that. I want to talk about specifically why the U.S. federal government policy, meaning Congress, doesn't get involved in home loans. Currently, we are in affordability issues in the United States. Currently. And so the interest rate is tied to several factors. Now, Congress could theoretically regulate banks to base home lending decisions on the prime interest rate. However, doing so would fundamentally alter the U.S. mortgage market, as mortgage rates are currently determined by supply and demand, the broader economy, and private risk assessments rather than strict government mandates. Now, why did I read that to you? Currently, interest rates for houses are based on other people's opinions in the country, and Congress, since they are talking about affordability, has not got involved and said, hey, the interest rate at 6.65, new homeowners or first time homeowners cannot afford that. So you decide whether that is legit to keep people from buying houses. Why? Because the mainstream media is saying it differently. They're blaming the war, they blame interest, inflation, etc., which are factors. But Congress could change this so that we could get houses. Now, Congress holds the broad authority to regulate banking and interstate commerce under Article 1 of the U.S. Constitution and through federal oversight agencies like Consumer Financial Protection Bureau and the Federal Reserve. Now, we know about the Federal Reserve because they meet and they influence the prime interest rate. And so when there was an argument between the government, meaning the executive branch, about getting interest rates down, they actually could have done that. What they've been doing in the past, and what we should be questioning, is their reasoning for leaving home loans so high. Now, there's other factors in the country, jobs reports, all of that stuff. And I think this is an opinion that we need to look at it differently when it comes to home loans and people having the ability to buy houses. So there's factors called the prime rate benchmark, risk pricing, inflationary pressure. Now, the last two, risk pricing and inflationary pressure, that is someone's opinion. And for people who are trying to buy houses, that seems a little bit unfair that someone else decides, well, that they people shouldn't be able to buy a house based on risk pricing, inflationary costs, and all of that stuff. They also, Congress does get involved. Congress does something called a government sponsor enterprises to guarantee specific home loan, which helps lower mortgage rates for qualified buyers. The qualified buyer means that you don't make a lot of money, and to them, you make a lot of money if you make over $60,000 a year. Because all you have to do is look at the federal poverty levels that I keep talking about, and you would see that most people who are working don't qualify for that. Then you got federal subsidies and regulatory easing. Okay, so let's get to it here. So since the Federal Reserve raised interest rates in mid 2022, Banks have generated over 1.15 trillion in cumulative net income, largely driven by expanding net interest margins. Again, since 2022, this is 2026, banks in the U.S. have made over 1.15 trillion in net income. Have you heard that on the news? So the banks are making money, but the people, the American people, are being told, well, we have inflation and we have to guarantee that the banks get their money. I had a house and I sold it. The interest rate was 3.35. And then I have a house now and it's over 6%. And the interest quadrupled. So for my house, for the amount that I'm paying to principal is $400. The rest of it, over $2,000, is interest paid to the bank. No one's talking about that. Okay, so to clarify our point on your numbers, the Federal Reserve target interest rate actually went from 0.25 up to the peak of 5.50 between 2022 and 2023. Now that is a lot. Again, no one's talking about it, but apparently me. And so let's look at how the Fed influences the prime rate. Dual mandate, federal funds rate, the prime baseline. Okay, so for us regular people, this doesn't mean anything because we understand that the economy and the movement of money and GDP works together to give them metrics. So to bring about the point of why are home loans tied to this? Because the interest rates in general for business, people like that, are always going to fluctuate. But for people buying homes, the people who have nothing to do with the economy and what's going on in the world, for home loans, they are getting punished. Also, note that credit cards are based on the prime rate as well, and also home equity loans and business loans. Okay, so we need to be aware of what that prime rate affects and what economists are using and banks to establish how people can borrow money. Because the bottom line is the U.S. federal government policy on home loans doesn't work for the average American. Look at the data. And the banks, I just told you, from 2022 to now are making over $1.5 trillion. So you decide what you want to do with the information. I would say talk to your congressperson and get them, Congress, involved into excluding home loans from the prime interest rate considerations so that our kids can buy homes, regular people can buy homes. So you decide. This is Just Listen, hosted by George Goodman. Let me know what you think.